All right, here. We'll talk about accounting, it's the nature of business and the role of accounting. I'll talk about some accounting principles, the accounting equation. We'll talk about business transactions, financial statements, and liability and ratios. So the nature of business and accounting, just keep in mind that organizations in which basic resources are used, materials, labor, assembled processes, outputs. So you've got inputs used, which is materials and labor, which turns into goods and services used by customers. And we're going to account for all that good stuff. And of course, businesses need to earn a profit, and the profit is the difference between, I got ahead of myself there, and the profit is the difference between basically what you sell your goods for and what you paid to make them or buy them. There's a few types of businesses out there: a service business, merchandising, manufacturing, a service business. Just they've got some examples there: entertainment, transportation, merchandising. We all know what a merchandiser is. A manufacturing company, and obviously the accounting will change a little bit based on the type of business we're looking at. And accounting is simply an information system. We provide reports to users about the economic activities and the conditions of a business so that users can make a decision about how the business has been run. And so the role of accounting in business, we need to identify who are the users of information about a business. What do they need? What kind of information do they need to make decisions? Design accounting systems to meet the needs of the users, record economic data about a business and its activities, and then prepare reports for users. So those are the things we'll learn about in the class. And so the role of accounting in business, obviously it's important. Step one, identify the users. There's both internal and external users. Internal users are management, ownership, other employees. External primarily is investors and creditors, but also potentially governments and customers. But investors and creditors are the big two. So just think basically anybody who would invest in our business or anybody who would give our business a loan. We'll then, of course, assess what are the needs of the particular user, design an accounting system to fit their needs, record the data, prepare outputs so that they can receive the information and make decisions. There's a few different branches in accounting. The first one is managerial accounting. Basically provides information to management. Deals primarily with cost accounting or just any kind of information that managers need to make decisions about how to operate the business. Managerial accountants employed by a business are employed in a private accounting. Typically, they work for industry. You work for a particular company as opposed to working for a CPA firm. The branch of accounting we're going to spend our time on in this class is financial accounting. The area of accounting that provides external users with information is called financial accounting. Okay, so external users, we identify the users and we design systems and give them the information that they need to make decisions. Primarily those are those investors and creditors. And of course, the users need information that is relevant and timely. So basically it's near the end of an accounting period to meet their needs. And so we have what we call general purpose financial statements, which are produced by financial accountants and given to those external users. So we're going to really spend our time talking about financial accounting. Ethics is a really big deal in accounting, and it should be in business overall. But accountants are typically held to a little bit higher ethical standard than maybe some other professions. And the reason for that is that you have these external parties like investors and creditors who rely on the work of accountants. And so if a bank is going to give a company a loan, or investors will buy stock or make an investment in a company, they're relying on the work of an accountant. and they're trusting that accountant to give them information that's timely, relevant, free of material error, has not been embellished, so that they can make decisions. And so, obviously multi-million-dollar decisions are based on information that accountants put together, and so having an ethical standard is very important. So ethics is just any moral principles that guide conduct in business. And the challenge with ethics is that, what can be ethical to one person, may not be ethical to another, for example. So ethics can be kind of a gray area. Different people have different views of what ethics are, but accountants are upheld to standards. There's basically accounting rules that say, how to be ethical and so on, that accountants are expected to follow. And so you can see here with this exhibit, you've got some different companies here in the left column, and you have some frauds that happen due to accounting breakdowns, bad management, intentional decisions to report falsified financial information. And you can see what happened because of that. People were fired, put in jail, companies went bankrupt, employees who were very innocent lost their jobs, and so on. So you can see there's a number of things here where accountants have made some really bad decisions and violated ethical standards, and there's been a direct consequences to that. So basically, the role of ethics in accounting, the answers to what went wrong with these companies, the answer is failure of character and a culture of greed and ethical indifference. So we have to be very careful of those things, obviously. And so the role of ethics in accounting, just kind of a 1, 2, 3, 4 step-by-step process to guide your ethical conduct in any business, regardless if you're accounting or whatever you're in. Step 1, identify an ethical decision by using your personal ethical standards of honesty and fairness. Use your moral compass that you have to help guide your decision or your situation that you find yourself in. Identify the consequences of your decision and the effect on others, and sometimes maybe it's not doing anything as your decision, or sometimes it's taking a particular course of action. Step 3, consider your obligation and responsibilities to those affected by your decision. How will they be affected, and do they need to be consulted or brought into this? And then make your decision that's ethical and fair to those affected by it. And I always say, don't make those decisions in a vacuum. You should really make those kinds of decisions with consultation from somebody that you trust. I think that's what you first of all would need to identify, is who can you trust to help you make a decision. The accounting field, what would you do with an accounting degree if that's what you're pursuing? Well, obviously going into public accounting is a big deal. Private accounting, you could be a certified public accountant, but there's lots of things you can do with an accounting degree. Even going work for the government hires accountants also. But public accountants would be doing accounting work for other businesses. If you work for industry, you'd go work and do just the books for that particular company. And then CPAs, basically just somebody who has education requirements, experience requirements, and has passed the comprehensive exam to become a CPA. So just some of those opportunities that you see out there in private accounting: bookkeeper, payroll clerk, internal auditors, IT auditors, general accountants, budget accountants, cost accountants. In public accounting, there's all kinds of different kinds of firms out there, local, medium-sized, national firms. And obviously, the bigger the company you work for, the more responsibility that you have, the more chance there is of earning more money, obviously. Let's talk about accounting rules. So when I say the word GAAP, GAAP, that stands for Generally Accepted Accounting Principles. And so remember that as accountants prepare reports that are given to outside third parties, those reports have to follow a certain set of accounting rules. And those accounting rules work for everybody in the country. They're the same no matter where you are, how big your company is. Everybody follows the same rules. And those rules, of course, are governed and created by a particular entity, and then one of the primary entities in developing what the rules are is called the FASB, which is the Financial Accounting Standards Board. So their primary responsibility is developing these accounting rules, and then answering questions about them, looking at rules constantly, making sure that they still make sense, that they should still be there, and changing as they need to change. Some other entities that involve or influence GAAP, the SEC is one of them. It's a government, created by the government agency, created back in the 1930s, and Congress, when they created the SEC back in the 1930s, actually gave authority to the SEC to create accounting rules. Now, however, the SEC typically does not do that. They typically defer that to the FASB, and of course they'll let the FASB know what they're looking at and what they kind of expect to happen, but generally they let the FASB take care of that. But basically any company that's publicly traded, so if we can go buy the stock of a particular company, they have to file with the SEC, and the SEC basically is overseeing all financial markets and making sure that financial markets are being run fairly, efficiently, that all companies that are publicly traded have to file certain things with the SEC on a timely basis. Really, it's just to make sure that all investors have equal access to the same information to make investment decisions. So they're just basically regulating the markets, making sure they're working properly. Many countries outside of the U.S. follow a different set of accounting rules called it's called IFRS, International Financial Reporting Standards, and those are overseen by a board called the International Accounting Standards Board, which is kind of basically the international equivalent to the U.S. FASB, the Financial Accounting Standards Board. Also understand what the business entity concept is. Basically, that a business entity is separate and distinct from its owners. Okay, so its records are kept separately, its cash is kept separately, and so on. So it's run independent of the owners, so there's no commingling of finances and records and things like that. So it's operated separately from an owner. And there's several types of business forms out there. Proprietorship is easily the most popular, very easy to create. Anybody can start their own business, start a proprietorship. It says that 70% of businesses in the U.S. are actually proprietorships. And so they're popular because they're easy and cheap to start. And really the resources are just limited to those of the owner. And of course, these are used by small businesses. So anybody can start one, and typically if you're going to start your own proprietorship, one of the first things you would do is just get a bank account specifically for your business so that you can begin to separate your personal funds from your business funds. Of course, you can also have a partnership, which is just simply two or more people working together to run a business. It says about 10% of businesses are run this way. There's advantages, of course, because two or more people working together have more resources, can combine skills. Maybe one person's really good at marketing, but the other person's really good at IT, or you can take people with different skills, match them together, and work together to start and grow a business. Corporations are probably what we're fairly familiar with, just because corporations are so big. And just drive down 41st Street and just think of the big companies that you see, and they're going to be corporations. And it says that corporations generate 90% of revenues. So keep in mind, 70% of businesses were sole proprietorships, but corporations generate 90% of all revenues. So obviously they're really big. 20% of the business organizations in the U.S. are corporations. And of course, if they have a corporation, that means they have ownership shares, which are called stock, which quite often you and I can buy. Not all corporations are publicly traded, but a lot of them are, of course. And so they have a lot of resources, obviously much more than a small business typically. Then another one that's a little bit newer and unique is called an LLC, a limited liability company. And it was created to give owners some of the advantages of both a partnership and a corporation. There are certain protections that you have by owning a corporation. And so There's some legal and tax advantages to own these, but they're not quite as complicated to create and set up as a corporation is. So it's kind of a hybrid in between, really created to assist business owners who don't necessarily need to be really big, but want some of the legal protections that corporations have. The cost concept just simply means that when we initially purchase an asset, we buy something, we record that at its cost. And the reason we use cost is because it's easy to identify. We've got some kind of a receipt or invoice that says, here's what we paid to acquire a particular item. And so, for example, Aaron Publishers, they bought a building for $150,000. Other amounts related to the purchase of this building are on the following slide. If you've ever purchased real estate, you know that you negotiate a price, but there's more to it than just that. And so you can see here they've got some information regarding the purchase. Now it says under the cost concept, the purchase price is $150, and the amounts listed in the blue up above the $150 in this example are just basically other information though. But the reason we use cost is because we negotiated that. We've proven that this is the value because there was a back and forth negotiation and we agreed on this. So the seller listed it for $160, but that's not the cost because it was sold for less than that. There was an offer for $140. They met in the middle at $150. They thought the selling price might be $220,000 in the future, or that a tax assessment might be $190 in the future. Doesn't really matter. It's more informational, but the only thing we'll actually record in our accounting records is the true value that was transferred in the agreed upon price. Objectivity basically just means that accounting records are recorded based on the evidence given, okay? And only the final agreed upon amount is the objective enough to be recorded. So there's all this data about this negotiation, but ultimately what it boiled down to is we agreed on $150 for the purchase price, and that's what should be recorded in our accounting records. Basically, unit of measurement just means we're using the US dollar to record information. Very simple, the US dollar, obviously. The accounting equation is definitely something you'll have to memorize and know. It's not hard to memorize, thankfully, but just know that resources are things that a business owns and that it uses to benefit the business in the future. Those are called assets. So just think of a business that would own land, a building, equipment, vehicles, computers, printers, you name it. Those are all assets. They're used for the business to help it earn revenue and deliver goods and services to customers. Now, quite often you have to borrow money from a bank, or you end up with some payables to various businesses, and those are your creditors, okay? And you owe them a liability. So a liability is an amount that you owe to an external third party. The rights of owners are called stockholders' equity, and so typically the equity section of the accounting equation deals with this is what the owner owns. This is how much that belongs to the owner of this particular business. And so you have the accounting equation, which always has to be in balance. And at the bottom point there where it says assets equals liabilities plus stockholders' equity. That's the accounting equation, which always has to balance. So both sides have to always be the same number. And so obviously assets are resources. Liabilities are the rights of creditors and are debts of the business, so they're external parties that we owe money to. And the stockholders' equity is basically what the owner's rights are. How much does the owners own of the assets? Okay, so let's talk about business transactions. A business opens. It needs to purchase items to start the business, inventory, advertising, hire people, insurance, maybe some legal type things, all those things that have to happen. And then once we finally got our business going, then we turn around and we sell stuff, goods or services to our customers. And every time something happens that can be measured, we have a transaction. So a transaction just simply some kind of event that directly impacts the financial condition or the results of operations of the business. Something as simple as I have a delivery business, I have a delivery van, I go to a local gas station and I fill up the tank, spend $100 of cash to fill up the tank. That's a transaction, right? My financial position's changed. I have less cash, but I do have more gasoline. I've got a receipt. I've got a way to prove this transaction happened. So just things like that, just the things that happen as the business is operating to keep it going. And so quite often one of the first transactions for a new business is the owner will start the business and take some personal funds and transfer them into a bank account set up just for the business. And that's a very typical entry to start a brand new business. So in this example, an owner is going to start a new business, deposit $25,000 into a bank account, and call this new business Net Solutions. And so now the business has an asset of cash of $25,000, and the owner has equity in that $25,000. So both sides of the accounting equation then balance. So Net Solutions is going to take that cash and use it to buy some land, so it has a potential site to potentially put a building on and operate from this particular location. And so we're going to buy some land, and so that means cash is going to go away. We'll subtract $20,000 of cash, but we're going to add land. So we still have $25,000 worth of asset. It's just that now some of it's land and some of it's cash. And then we're going to buy some supplies. Supplies are an asset, but it says we're going to pay the supplier in the near future. Near future means we're taking the supplies now, we get possession of them now, and we'll pay for them sometime in the future. So we're getting credit from the supply store. Okay, so we debit an asset, or we increase the asset supplies. We now have more asset. But on the flip side, we now owe somebody for those assets. So we have an account payable now of $1,350. And so that was called an account payable. Okay, so we owe somebody external. We take an asset now, we pay for it later. It's called an account payable. Items such as supplies that we will be using in the business in the future are called prepaid expenses, which are assets. So basically we buy the supply now, we prepay for it, and we'll use it up in the later, and as we use up supplies, they turn into expenses. Another transaction is we're going to receive cash because we provided some services to our customers. And so, of course, when we provide services or sell goods, that's called revenue. And so we're going to deliver goods and services to our customers. They're going to pay us. We're going to receive cash. And so now we have more cash and we have more fees earned or revenue, which increases our equity section. And so revenues provide services. Revenues from providing services are recorded as fees earned. Revenue from sale of merchandise is called sales revenue. They're both revenue. We just call it a different thing based on if it's a service or a good. There's all kinds of examples of revenues. If we rented something to somebody, that's rent revenue. If we can have interest revenue. If we lent money to somebody, they pay us interest back. An account receivable is basically a claim against a customer. So we could sell goods or services to a customer and say, you can take those things now, but you'll pay us later, and that would be an accounts receivable, which is an asset. Another example is we're going to spend some cash or potentially use up assets to earn revenue. So basically think of it this way: every time we earn revenue, some kind of expense had to happen to earn that revenue. Okay, so it's either using up an asset or spending cash, and that's called expenses. So an example of an expense, there's several examples here: wages, rent, utilities, is miscellaneous. So as we're paying our bills, writing checks, you can see that cash is going down and we're incurring a number of different expenses, which of course will impact stockholders' equity. We're going to pay our creditors on account. Remember, we bought those supplies on account. We're going to make a payment towards paying off those supplies. We're going to, less cash, but also less liability at the same time. On November 30th, 2013, Chris Clark determined that the cost of supplies on hand was $550. So basically, he got to the end of the accounting period, the end of November. He does a count of supplies and go, okay, I have $550 worth of supplies on hand. That means I used up $800 worth of supplies. So I subtract $800, I get $550 left. And so I make an entry to reduce supplies by $800 and transfer that into supplies expense. We're going to pay a dividend to the owner. Obviously, Chris is the owner. He can put money in the business as he wants. He can take money out of the business as he wants. So he's going to pay himself a dividend just to basically pay himself for his work for the month. He's going to take $2,000 out of cash and then also deduct that from equity through an account called dividends. And so lots of things happened here with these particular transactions, but you can see that the accounting equation was always in balance, no matter what. With every single transactions, assets always equaled liabilities plus equity. And then we get to an account called retained earnings. And retained earnings basically is all of your revenue and your expense transactions. So you can see we had a revenue of a plus $7,500, a whole bunch of different expenses, and the net between the two is $3,050. And that $3,050 then basically is your net income, your revenues minus expenses. Okay, so it says, note the following: the effect of every transaction has an increase or a decrease in one or more of the accounting equation elements. So it could have been affecting two assets, like one asset goes up, one goes down, or asset and liability, or asset and equity, and so on. Okay, so the two sides of the accounting equation always balance, which I mentioned, and equity is increased by amounts invested. So if the owner puts money in the business, equity goes up. If the owner takes money out of the business, equity goes down. Equity goes up for revenues and it goes down for expenses. And I've already mentioned the equity goes down for dividends. Retained earnings then is just simply the equity created from the business operations. Okay, so as we delivered goods and services to our customers, we earned revenues. As we paid our expenses, as assets got used up, we incurred expenses, and so revenues less expenses equaled net income. And so the types of transactions and how they affect equity are right here. So owner investment makes equity go up. Dividends, which is money coming out and going back to the owner, makes it go down. Revenues up, expenses down. And then the difference between revenues and expenses is either net income or net loss. If you have more revenue than expense, net income. If you have more expense than revenue, net loss. So that's part of something you're just going to have to remember right here. So I know it's going to take a while, some practice to get to know that, but just as you practice that, that will help you tremendously. Okay, so let's talk about financial statements just a little bit. After transactions have been recorded and summarized, then we prepare reports that we give to users, and these reports are called financial statements. And they're very standard in the way they look and are set up, because I remember I mentioned that these accounting rules that we follow apply to all companies, and so it's kind of a standard format with how financial statements should look. And so we'll take a look at some here in a bit. So the first financial statement is called the income statement, which is a summary of all revenues and expenses for a specific period of time, either a month, a quarter, a year, kind of whatever time frame you want to look at. So an income statement then reports revenues less expenses, and we use a concept called the matching concept, where we want to match expenses incurred to revenues earned in the same accounting period. Okay, so the excess of revenue over expense then is simply called net income, net profit, or earnings. The retained earnings statement then shows what made retained earnings change from the beginning of the accounting period to the end of the accounting period. Okay, that's an important one also to remember. So here's an example of a retained earnings statement. It says, to illustrate, assume net solutions earn net income of $4,155 and pay dividends of $2,000 for the month of December. So their beginning retained earnings on December 1st was $1,050. They had a good month. They had net income of $4,155. That makes retained earnings go up. But the owner took $2,000 out, which makes it go down. So at the end of the month, December 31st, then it was $3,205. Here's what the example of the income statement. It's revenues less all the expenses incurred in that month. So this is November's. And it says that for November, we had revenue of $7,500, expenses of $4,450, net income was $3,050. That $3,050 then is transferred to the statement of retained earnings. So we start, November was the first month for the business, remember. That's when it just started. So we started out with 0 retained earnings. After 1 month, we had $3,050 of income, which made retained earnings go up. The owner took $2,000 out, so the ending retained earnings was $1,050. The balance sheet lists all of our assets, liabilities, and equity as of a specific date and time. It kind of proves that the accounting equation is in balance. And so the account form for the balance sheet lists your assets on the left, liabilities and equity on the right, adds them all up to make sure that everything balances and that the accounting equation is in balance. So it kind of takes on the form of the accounting equation. And so it says that cash is compared to the net cash flows in the statement of cash flows, which we haven't looked at yet, which we will. On the right-hand side, it said that that $1,050 came from the retained earnings statement. That was the ending balance of retained earnings as of November. And so the financial statements are all related to each other. One number from one flows to the other. And you can see that assets is $26,450 and liabilities plus equity is the same amount. And the statement of cash flows then basically just says for a particular time period, the month of November, month of December, whatever we're looking at, it basically says here's where all of our cash came from and here's where our cash went, organized into 3 categories of operating, investing, and financing. So it's a summary of sources and uses of cash organized into those 3 categories. So here's an example of a statement of cash flows. So we start out with cash received from customers. We deduct cash payments. We get to net cash flows from operations. Then we have cash flows used for investing. Remember, we bought some land. That was an investing transaction. And then anything that deals with financing typically deals with dividends and things like that. And so you can see that's where we had that $2,000 withdrawal come out. And so basically it just says our cash balance should be $5,900, which matches the balance sheet. So cash flow from operations deals with the summary of cash receipts and cash payments from operations. So whatever our business does in terms of buying and selling goods or services, that should be your cash flow from operations. Cash flows from investing typically deals with buying and selling long-term assets, permanent assets. And cash flows from financing typically deals with transactions involving your equity section and borrowing. Okay, so when the owner took dividends out, that obviously was financing because that affected equity. And then just kind of keep in mind the relationships between financial statements. So income statement and retained earnings, the relationship to net income or net loss, whatever that is, goes to the statement of retained earnings, and so on. Okay, so there's definitely a relationship between the financial statements to keep in mind. So net income of $3,050 from the income statement then goes to the statement of retained earnings to make retained earnings go up, for example. Okay, so then whatever the ending retained earnings number is then goes to the balance sheet. So the ending balance of retained earnings was $1,050, and that's what you see on the balance sheet. Then also the $5,900 is also what the ending balance of cash is in the cash flow statement. And that's what they're going to tell us right here. Okay, the final thing to talk about is just the concept of ratios. And just know that as we move through the book, we'll talk about different ratios. And the first ratio you see here is liabilities divided by equity. And so you can see here, we just took our $400 worth of liabilities, divided that by equity, and we get a number, pretty small number, 0.015 or 1.5%. And so that just basically says, how much liability do we have to equity? Now, with this being a brand new business, there's really nothing to compare it to, but ideally, as this business continues to move along and have more operations, we will of course have more opportunities to compare that ratio over different time periods and get a feel for, is it improving or getting worse. Plus we can also compare that ratio to our key competitors or to an industry average.